Selecting the right ETFs to hold long term is one of the most important decisions you need to make in your investment career. You want to pick something you're unlikely to regret or change your mind about later on, and that you're happy to hold forever no matter what is being hyped up at the time. That's why today we'll talk about what I believe to be the best world ETFs to accomplish that goal and which one I would choose if I was starting from scratch right now. In a way, ETF investing is like marriage. Ideally, you want it to last a lifetime, so picking the right partner from the get-go is essential. You're going to go through thick and thin since regular corrections and crashes are a normal part of how the stock market functions. Much like dating, you want someone you enjoy traveling the world with, global diversification, not too high maintenance, low total expense ratio, stable, large fund size, and reliable, closely tracking the index. Alright, enough of the cringe-worthy analogies, let's get serious. As you probably know by now if you've been watching my videos, I strongly believe investing globally makes a lot more sense from a diversification perspective compared to focusing on stocks from a single country, even if that country is the US. That's because nobody knows what the future holds and where the best performing, most innovative publicly listed companies are going to be based in the coming decades. By passively investing into ETFs covering the entire world, we can make sure both the current and future winners are part of our portfolio, no matter where they're located. And since we're basically buying the entire market, we're a lot less likely to regret our choice or want to switch investment strategy in a few years, a decade or more. That's something that happens way too often to the majority of investors that get caught up in whatever is being hyped up at the time. By the way, before we review the first few ETFs that fit our criteria, don't forget to subscribe to the channel if you haven't yet. Also, if you'd like to support me and check out the best low-cost brokers in Europe for ETFs, you can find those linked down below in the description, in addition to the ticker symbol for any ETF I mentioned today. So, here are my selection criteria for finding an ETF to hold forever. First, it should have a low total expense ratio and closely track the underlying index. Second, the ETF should be a couple of years old and have a fund size of over 100 million euros at the very least to minimize the risk of our ETF being closed down during our holding period. Third, the replication method should be physical since we want it to actually hold the stocks from the index it's trying to cover. Fourth, I'm excluding ETFs with currency hedging since this doesn't make sense with globally diversified ETFs and only adds unnecessary costs without benefiting our performance long term. Fifth, I'm also excluding ESG ETFs, where index providers seem to make different, often irrational decisions on which stock is ESG and which isn't, and I believe in passively buying the market as a whole. And lastly, I'm mainly going to focus on accumulating ETFs so we don't have to waste time or fees on manually reinvesting dividends, since the ETF is doing this already within the fund itself, raising the share price by the amount that's reinvested, compared to a distributing ETF which pays out the dividends. Okay, let's start with ETFs on the best known global index, the MSCI World. The MSCI World is made up of over 1,500 large and mid-cap stocks from 23 developed countries across the world, covering about 85% of the free float market cap in each country. Based on the criteria I outlined a minute ago, these are the two ETFs I would pick, with the SPYI ETF having a slight edge over iShares due to its lower total expense ratio and better performance since 2019. If you prefer a distributing ETF that pays out the dividends to your account on a quarterly basis, my number one pick would be the HSBC MSCI World with a total expense ratio of 0.15% per year, which actually managed to outperform both accumulating ETFs I mentioned since 2019 due to its excellent tracking difference. A much lesser known but equally interesting global index is the FTSE Developed World. Its advantage over the MSCI World is that it's a bit broader, as it covers a few extra countries like South Korea and Poland. It contains a significantly larger number of stocks, over 2,100, that's 40% more than the MSCI World, and includes a small percentage of small cap stocks as well. As a result, I would actually prefer this one over an MSCI World, since it would enable me to be a bit more diversified and cover developed markets more broadly. With a fund size of over 1.3 billion euros and a low total expense ratio of 0.12% per year, I consider the Vanguard FTSE Developed World an excellent ETF for a one ETF strategy. And there's an equally good distributing version as well if you prefer that. But wait, there's another world index you may have never heard of before, issued by a German index provider, the Solactive GBS Developed Markets Large and Mid Cap Index. Covering about 1,500 stocks from developed countries, it's almost identical to the MSCI World, also in the countries it contains. Now here's where it gets interesting. The two Amundi Prime Global ETFs covering it have by far the lowest total expense ratio out of any ETF on today's list at only 0.05%. Just looking at that, you might assume it's a no-brainer to pick this one instead of an MSCI World, but sadly it's not that easy. These ETFs are domiciled in Luxembourg instead of Ireland, contrary to all the other ETFs I mentioned so far. Why does this matter? Well, the reason why so many ETFs containing US stocks are domiciled in Ireland is because the country has an advantageous tax treaty with the United States, which reduces withholding taxes coming from US dividends from 30% to only 15%. Meanwhile, ETFs domiciled in Luxembourg aren't able to take advantage of that reduced rate. You can see the effect this has when comparing it to the MSCI World ETFs we mentioned before, which sadly cancels out the Prime Global's incredibly low total expense ratio. As a result, this one won't make the cut for me personally. Now, if you want to cover emerging markets as well in addition to developed markets within one ETF, to make sure you have no regrets in case stocks from major emerging economies like India or China outperform in the future, then the FTSE All-World could be the perfect choice. It covers over 3,600 stocks, not only in a large and mid-cap segment, but also a small percentage of small caps, all within one ETF. It captures about 90% of the global market capitalization. This is how my wife and I have been investing as well over the past couple of years. We just buy a single ETF, the accumulating Vanguard FTSE All-World every single month. Compared to the ETFs I mentioned so far, its expense ratio is a bit higher at 0.22%, but luckily its excellent tracking difference makes up for it. And I'm confident Vanguard will reduce its fees as well in a not too distant future, especially now that the competition has been pushing fees lower. With many billions of euros in assets under management, it's one of the most popular ETFs out there, and for good reason. You can buy it as either an accumulating or distributing version, both of which are available as recurring investments on Interactive Brokers and Trade Republic as well, linked down below in the description. Had I made this video last year, I would just close our selection here. But as luck would have it, we have one more option that's worth looking at. The MSCI All-Country World Investable Market Index, which aims to capture as much as 99% of the global market capitalization by covering a grand total of over 9,200 stocks, large, mid and small cap, from all over the world, including emerging markets. It doesn't get much broader than this. There's only one ETF out there covering this index, the SPYI IMI, which has rapidly grown in fund size to over 790 million euros, since lowering its total expense ratio from 0.4% all the way down to 0.17% per year. Due to everything it offers, like its broad diversification across both developed and emerging markets, including small cap stocks according to their market capitalization, as well as its low expense ratio and its excellent average tracking difference, this is undoubtedly one of the most interesting ETFs out there for a one ETF portfolio right now. So in summary, these are the 4 ETFs I would take into closer consideration for a lifelong one ETF investment strategy. Since they're well established due to their age and fund size, the risk of any of these being closed down during our investment career is very low. In case you prefer distributing ETFs that pay out dividends to your account instead of reinvesting them within the fund, you can find those in the description below. Now let's get to the question which ETF I would pick if I was starting from scratch today. Since I don't mind that it's only available as an accumulating version, I think I would go with the SPDR MSCI All-Country World Investable Market Index ETF due to its inclusion of a larger number of small cap stocks, which could enable me to capture some of the size premium as well long term. However, I'm actually going to stick to buying the accumulating Vanguard FTSE All-World since Vanguard ETFs are a bit more tax efficient in Austria. Sadly, we have very weird tax laws here when it comes to ETFs, and taxes are something you should always keep in mind throughout your investment career. Either way, the performance difference between the SPDR and the Vanguard ETF is likely not going to be that significant long term, and I'm confident Vanguard will lower its fees as well in the not too distant future. Ultimately, I believe what matters most is that you don't flip-flop from one ETF to another, and that you're willing to hold whichever world ETF you buy for the long run. There is nothing wrong with you deciding to add another one later on, since it shouldn't change your reasoning for buying the previous ETF and thus keeping that in your portfolio as well. What you should not do is sell existing shares of one broad-based low-cost world ETF that's in profit to buy another one that's slightly cheaper or just a bit more diversified. That's because the tiny difference in fees is most likely not going to make up for the amount you lose due to any taxes you're now forced to pay on profits you realized by selling. That's why my wife and I are still holding on to our Xtrackers MSCI World ETF shares, which we bought back in 2017, as it's still in line with our global investment strategy, before making the switch to the distributing Vanguard FTSE All-World, and ultimately the accumulating version to make investing both easier and more tax efficient for us long term. Now, if you're based in a country without capital gains taxes and none of this matters, then good for you. Please don't rub it in our face. But in that scenario, you probably have another issue. You may be tempted to time the market since there's no tax consequence to you selling shares anytime to rebuy at a later date, which is a bad idea as it ends up underperforming in the vast majority of cases. Alright guys, I hope I was able to give you some ideas for a simple one ETF investment strategy covering the entire world. I'm curious to know which ETF you would pick if you were starting today, so please let me know in the comments. Before you take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. Every ETF I mentioned is in the description below, where you can also find links to the best low-cost brokers in Europe for ETFs, which is a great way to support me if you'd like to. Also, please keep in mind that none of what I mentioned today was of course meant as investment advice. I'm just openly sharing my opinion based on my personal experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.